Because at this point, in order for things to start going right, we know 3% GDP, we need 10% GDP. We need 10% GDP for like a year and a half straight in order for things to get really back on track. We need payroll growth at 500,000 a month for a year just to have a prayer of getting back to even close to the pre-crisis or the pre-2020 baseline. So we're not really conditioned and set up to look at the economy under these circumstances.
I understand. So I guess, what do you think the probability would be of the United States, the actual numbers, the headline numbers, starting to look more like Europe? Because I also want to caution people that although this time may be more like a balance sheet recession that we saw during the dot-com, just because we have seen the 10-year go up and just because you do have positive GDP, it doesn't necessarily mean that it's not 2008. That's one thing I always point out is, when the Fed started cutting rates back then during that cycle, it was you have the same starting point at 5.25%, same date. And now what's different is they pause in January. Back then they were cutting aggressively in January. But the 10-year Treasury from March to June, July in 2008 went up by 100 basis points. While the Fed was cutting dramatically. So just because that's happening now, again, it doesn't mean that we're in 2008, but it doesn't mean we're not in 2008. And I also like to point out the CPI from September of 2007 went from right around 3%. And you fast forward to June or July of 2008, and it was up at 5.6%. So a massive increase in the CPI. And during this time, what was the mainstream narrative? It's the Fed's cutting too much and Fed's cutting, exactly, inflation. The Fed cut too much. The economy is on fire. The Fed cut too much relative to the underlying fundamentals of the economy. And therefore, you're going to get this consumer price inflation, the reacceleration. And if you look at the Wall Street Journal in June, July of 2008, they're talking about how the Fed will likely have to start hiking rates going into the end of the year. And we all know how that played out. So again, I'm not predicting that it's the same, but I just want to highlight the fact that just because we have the numbers going in the opposite direction, it doesn't mean that it's not the same, because we saw the data play out in a similar way back during the GFC.
Yeah, and I think it's really about what we're talking about is different degrees of weakness. And so you have an economy that is not resilient, that is weak and showing signs of being weak and getting weaker. And then it's deciding about how that plays out and what parts of the economy suffer from that most. And again, there's geographical differences as well. So it's really difficult to kind of piece together. You want to focus on one place or another, we can't follow any specific template. It's not like the economy always follows a template, which, it seemed like that was the case in the United States with recessions. Milton Friedman's plucking model, which he basically said recessions look the same in the entire post-war period until 2008 came along and shattered that template completely. So it's difficult to say, okay, the recession looks like this and it only looks like this. Well, there's different ways that recessions can play out. And what we're really saying here is that what we're seeing in 2025 through the markets, through the data, through central bank reactions, is that there is some degree of weakness that is over and above what we would consider acceptable. And what does that actually mean for 2025 is very difficult to say because, again, unique set of circumstances make it hard for us to make a lot of comparisons. We don't know. Possibility you just cited, George, is not out of the question either. There could potentially be a more traditional type looking recession up ahead of us here in the second half of 2025, for example. It may be that tariffs are the straw that breaks the camel's back, and what was sideways weakness suddenly becomes, the downside off of a cliff. I think that's the real danger that central bankers are actually reacting to, or actually trying to prevent. They're seeing the sideways in all their economies too, and thinking, the longer this goes sideways, the greater the chance it goes over the edge and off the cliff. Therefore, we want to do everything that we possibly can to lower the chances of going over the edge. And that's really where all these central bank rate cuts are coming from. They see the sideways and they're worried about the V shape showing up afterwards.
And what makes it even more difficult, Jeff, is number one, you've got to compartmentalize between the economy and the stock market. Which is very tough for the retail investor to do. And
Well, it starts
then,
with the public, right, George? I mean, we're taught that stock market is the economy is the stock market. You hear it all the time. It's those two are used interchangeably.
yeah, I would argue more recently, there's probably an inverse correlation because the whole good news is bad news and bad news is good news. But then as an investor, what you have to do, and this is where it gets really tricky, is you have to realize it matters what the market thinks. So even if you're listening to Jeff Snyder and you're saying that makes a lot of sense, what he's saying, that we should be at 10% GDP growth, or we should have 500,000 jobs a month. And if we're not there, then we're way below trend. And that means the standard of living is not what it should be. And the economy is not running on all 8 cylinders. And you could buy into that. Yeah, that could make total sense. I'm probably in that camp. But then you have to realize that if you're setting up your portfolio, none of that matters, because if the market looks at 3%, and if the market looks at 150,000 jobs with the establishment survey and comes to the conclusion that the economy is booming, well, then the price action is going to reflect what the market thinks, even if the market is wrong. And that's where it gets so darn complex, I think.
Yeah, I would, the market is looking for the same things you raised, right? The market says, historically speaking, stocks go down when we see a traditional type recession. So when we see negative GDP and negative payrolls, that's when stocks go down. And so for the last couple of years, really going back to late 2022, the market has been, okay, if we see signs of negative GDP and negative stocks, we're going to sell, sell, sell. But if we don't see those signs, we don't care. It's almost like a bimodal model, right? It's either the economy is growing and it's just fine, or it's falling off 2008 style.
Right.
And as long as we're not in the falling off 2008 style, it's buy, 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 buy.
That's very well put. And then when you combine the other variable of the Fed dropping rates.
Oh, that's even better. That's more punch bowl, baby.
Exactly.
Yeah, so I think that's the challenge here, is because what we're saying is that the economy sucks. We know it sucks. Central bankers are telling it sucks. Politicians are getting thrown out of office because it sucks. Yet stocks are zooming ahead because stocks are only afraid of 2008 style recessions.
Yeah. Why are the economies so interconnected? So why is it so hard for the United States to avoid a sucky economy if China is in recession, UK, Germany, Eurozone, etc.? And the way I would answer this is it has a lot to do with the global monetary system, because it's just a network of bank balance sheets. So if you have risk outside of the United States, you basically have risk inside the United States as far as a lack of liquidity, because regardless of what the central banks are doing, at the end of the day, liquidity revolves around the commercial banks, not the central banks. But I'd love to hear the way you would respond to that question.
Yeah, there's a whole different ways in which you have these interplaying variables, right? I mean, monetary systems, one, global marketplace itself, commercial marketplace, non-financial marketplace. You have large multinational companies, large companies that are reacting to weakness, say in Europe. Well, they're not going to just change their operations in Europe. They might trim some of their payrolls in their US headquarters based on European weakness, because that's going to reduce their earnings and earnings potential based on, their global operations. But yeah, to go back to what you said, I think one of the things that you can see this visibly, where there's the global monetary and financial and banking regional banks. Kudos to them. It didn't spiral out of control into some type of massive 2008 and worse banking panic all over the world. So great job, Federal Reserve. No, we don't even have to worry about the bank crisis. It's just a curious little footnote that'll go into history. But if you look at economic statistics all over the world, as well as market prices and behavior and interest rates and everything else, you see a very clear inflection March of 2023. In fact, in the bond market, you see it in Germany, you see it in Canada, you see it in the United States, where interest rates that were following along with central bank rate hikes stopped doing so March 10th of 2023. And ever since then, whether it's Germany or Canada, the US, doesn't matter, long-term rates and even short-term rates, like the 2-year maturity, have been sideways, even though central banks continued to hike for a couple more months afterwards. The entire global bond market, says SVB, this is going to be a big deal, not just for the U.S. This is not just a regional U.S. regional bank thing. This is going to be a big deal for the entire global economy. And you can see a whole bunch of macroeconomic statistics. I just working on Germany's industrial production, which is the saddest, most depressing statistic you'll see for a number of reasons. I mean, German industrial output is down to around where it was in 2010. I don't mean growth rates or negative growth rates. I mean actual level of output, where it was coming out of the Great Recession, back in 2010.
Right.
And where did that really start to fall off again? Yep, March and April of 2023. So it never recovered. What little recovery there was in German industry stopped in March of 2023. You could say that's a gigantic coincidence, and that's just, or you're just confusing correlation for causation, but that's far from the only one. And so you put that together with the market behavior, as well as so many macroeconomic statistics. When did the U.S. unemployment rate begin to rise? May of 2023. Couple months after the low, a couple months later, May of 2023, First Republic had just failed. So either these are all gigantic coincidences, or you really need to start looking at the global system as a global system, because otherwise you're left thinking, what does the failure of a couple U.S. regional banks have to do with German industry and German bond markets? It's like you said, George, it's a globally interconnected financial and monetary system where if you have major problems and major fears over here, what seems to be an isolated part of the system, it does have impacts that ripple through the entire system and come out on the other side of the world. And let's face it, there's no shortage of things to be concerned about where it comes to global economic and macroeconomic factors and financial factors and banking factors. We haven't even touched on China yet, which is a huge one. And there's absolutely relationships with the Chinese as well. So
talk about China for a moment, Jeff, because I don't know that Americans know the problem is over there. And I know they've had just a massive balance sheet recession where the real estate prices have contracted by 30% or so, which doesn't sound like a big deal until you look at the total number was 60 trillion is the largest asset class in the world. And so you had about $20 trillion of purchasing power just get wiped right off the top right there in the last, let's say, 2 or 3 years. And you got to say, how on earth does that impact aggregate demand and purchasing power going and mentality of the consumer? But then what's weird is that they don't have negative GDP. So how on earth are they having this massive balance sheet recession or depression? And while at the same time, they're still able to grow at 5%.
Well, we don't know that they don't have negative GDP. We don't know that for sure. And I don't think we'll ever know for sure because GDP is notoriously unreliable in China. And there are a number of different alternative calculations that are out there. The Conference Board puts one together, and there's a couple other sources.
Oh, the Conference Board puts one together for China?
Yeah, they look at China and look at different statistics. In fact, I think it was former Premier Li Keqiang who had a sudden heart attack at the end of 2023 or 2024? 2023. He said in private, I don't look at GDP either. I look at electricity output and a couple other real economy statistics. So the point is that all of these others, it's nowhere near 5%. It's probably closer to 1%, maybe 2%. And there's a chance that every once in a while it actually does turn negative. But that's getting back to your main point, George. I think what you're seeing is not lost purchasing power just yet. That level of deflation hasn't actually hit the real economy because the banking sector has shielded the real economy and has been sort of the marginal shock absorber for the entire Chinese system up until more recently. So as the real estate sector has gone down, it's really been the banking sector that has absorbed most of that, and it has been able to, squirrel that away and hide it away from the public.
Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando May 23rd through the 25th.